This episode of Talk Your Book is proudly brought to you by Stock Doctor.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
David Prescott, the inaugural guest for Chris Judd's Talk Your Book. Thanks for coming on. I thought it might be a good place to start by hearing about Lanyon Asset Management and what you guys look to invest in.
Yeah, great. Thanks for having me, Chris. Great to be the first guest. So we're a concentrated value fund. We've been going for 10 years, offices in Sydney and Adelaide. We work with a number of institutional clients, including charities, philanthropic groups, a lot of family offices. We run highly concentrated value funds, so really research intensive bottom-up process. And in our funds, I suppose a point of difference is we hold lots of cash, and we have for a long period of time. That's sometimes a frustration for our clients, but we think it's the most sensible way to manage capital through the cycles.
50% cash, I've heard on the grapevine.
We have averaged a lot of cash. That has frustrated a few of our clients through the journey, but we've been able to achieve our performance objectives while holding a lot of cash. So we think it's sensible. We think it's a luxury and a privilege that our clients give us, but we think it's the most sensible way to manage capital.
And what stock we're going to talk about today?
So today I'm planning on talking about what is the most profitable ride-sharing company in the world.
Is it the only one?
It's pretty, as far as we can understand, it is the only one. So it's not one of the US or Asian ride-sharing companies. It's an Australian company called A2B. Most of your audience, I think, would understand that business as being the old cab charge business. It changed its name last year. So A2B Australia is listed on the ASX with the code A2B.
And had a choppy background of late. It feels like it's a bit of a turnaround story. What do you sort of look for in turnaround stories when compared to a company that's been consistently performing well for an extended period?
Yeah, you're right. So it's had a challenging few years, and some of that's been driven by some of those ride-sharing companies, which I'm sure we'll talk about. But turnarounds specifically, I think the key for us when we're investing in turnarounds is to understand what has gone wrong. Is it a cyclical issue? Is it a structural issue? Is it a execution issue? So management executed poorly. Has something happened out of left field that the company's been unlucky in a way? So we need to understand what's gone wrong, and then make an assessment of whether or not we think the company can fix the problems. And there's a couple of things that we demand when we're investing in turnarounds. They're really not negotiables. The first is we need an experienced management team. They need to be experienced in one of two things, either specifically in the industry that we're talking about. So, they have to have deep-seated experience in that industry, or they have to be a turnaround specialist. And what I mean by that is they have to have experience in having delivered a successful turnaround. The other thing that we demand is a really strong balance sheet. So if you look at most of the unsuccessful turnaround stories through history, most of them have been driven by companies that have had a challenged balance sheet. They've started with a capital position that's been very difficult. So we demand, when we're investing in turnarounds, both of those things. Experienced management team, but a very strong balance sheet to support them through what typically takes longer than what most people would think.
And where do A2B's management fit in that category?
So we think they're excellent, actually. So Andrew has been with the business, the CEO has been with the business a long time. He has successfully invested in tech and really repositioned this business. The core of the business hasn't changed, but there's been a significant amount of disruption that he's had to deal with, and we think he has navigated through a challenging period very, very well. He's positioned the business, we think, for the next phase of growth. So this isn't a traditional turnaround in the strict definition of a turnaround story, but we're really pleased with the work that they've done to date.
And what are the different business units of A2B?
So really, we break it down into two broad areas. The first is they're a network, so they're a taxi network. So your audience will be familiar with brands like Silver Service and 13 Cabs. So there's around 22,000 taxis in Australia. About 10,000 of those taxis are part of the A2B network. And predominantly they're those two networks that I speak about.
But they don't own the actual taxis, do they?
They own some taxis, but by and large, they don't own taxis. They own 250 plates, but on the whole, they're just a network. And a network is exactly as it sounds. You know, we like businesses that can achieve network economics or benefit from network economics. This is a network, so it makes sense for drivers to be part of a network, and the more drivers you have on the network, the more likely the customers are to use your network. So we think that is a good business. There's some issues which I'm sure we'll talk about, but we like that business, and the revenue model is essentially drivers paying a monthly fee to be part of the booking network. There's some other fees, insurance, training, access to depots, repairs, that kind of stuff, but predominantly that's a subscription-based business. The other part of the business is payments. So historically, when you went into a taxi and you paid with a card, an EFTPOS card or a credit card, you were slugged a 10% service fee. That's now nationally 5%, but that comprises around about 20% of their revenue base and a significant part of their profitability.
And which of those units excite you the most?
Well, we think the network is defensible. We think that's a good business. It's growing. It's been growing over years. We think more taxis are likely to join that network over time, and we think that there are acquisition opportunities in that space. Not so much here in Melbourne and New South Wales, but in some other geographies there are opportunities, particularly in the West, for them to acquire new taxis to join that network. The payments business, so that surcharge or the service fee has been reduced from 10% to 5%. We think that there's always a regulatory risk with this company. There's a chance that gets cut a little bit further, but we think that that's about right. We think that's a reasonable surcharge to be charging people to use a payments terminal in the taxi.
And those acquisition opportunities, they bought, was it Gold Coast Cabs or a business in the Gold Coast?
That's right.
For 2.5 times EBITDA once you take out the integration savings. Incredibly cheap multiple. Can you see those sort of businesses being plentiful that they can roll up into their business?
Not plentiful. So they have half the market already. So they have almost 50, not quite a 50% market share, but growing to a 50% market share. They are under-penetrated in the West. It's quite interesting, the shareholding structure of A2B. Their largest shareholders are a group called ComfortDelGro, who are a Singapore-listed transport conglomerate, really. They own 10% of A2B, but they also own the biggest taxi network in WA. So in our view, A2B is either going to acquire that network potentially, or maybe organically try and grow a network in the West, which potentially would create some conflict with their major shareholders. So it'll be interesting to see that play out. We don't factor in or assume that they're going to be able to buy a number of assets at 2.5 times going forward. That would be, as a shareholder, that would be delighted to see that, but that's not a core part of our thesis.
Yeah, and so when you look at this, and I guess there'll be times you've compared it to the valuations done at Uber.
Yeah.
Talk us through how those two businesses compare, value metrics of this effectively ride-sharing network compared to an Uber.
Yeah, I mean, Uber is an extraordinary company, and it's been a phenomenal story to watch. I think most people in Australia would have used Uber or had some association with Uber. What a lot of people don't realise is Uber probably needs to change. It's listed on the stock market in the US, as you'd be aware. It's one of the worst performing floats. Had one of the worst first days of any listed company, new IPO in the US ever. It's performed very poorly. The company actually lost $5 billion, so that's a big number. They lost $5 billion in the last quarter. It's a company with a market cap of about $50 billion. When you strip out the abnormals, which is really stock-based, the expensing of stock-based compensation, they still lost over $1 billion.
The revenue's growing at 20%, it's not growing at 150%.
No, that's right. It's in our view, it's getting to a more mature stage of its life. And the other thing that's happening with Uber, in our view, is there is some dissatisfaction amongst the drivers. There's 250,000 Uber drivers in the City of London. There's 60,000 Uber drivers in Australia, and these guys or girls have to supply their vehicle, as you know. They have to maintain their vehicle in a good state, and many of them are earning less than the minimum wage. So, and their customers, unfortunately, Uber's customers are they're just not sticky. You know, they've been unable to retain customers, and especially the younger generation, they switch from app to app. They'll look at Ola, they'll look at Didi, they'll look at Uber, and they'll pick the best fare. And so we think that model needs to change. How long equity markets will continue to furnish that company with cash, we don't know, but we think that's a business at an interesting kind of inflection point. When we compare that to, as I said at the outset, you know, the most profitable ride-sharing business in the world being A2B, we think they're incredibly well placed to almost go toe-to-toe with Uber domestically here in Australia. And that might sound like a courageous thing to say, but the reality is A2B have a very strong balance sheet. They do have a network of drivers. They've been able to withstand that onslaught reasonably successfully, we would argue. You know, one of the things that surprises people when we talk about A2B is when you look at their last 12 months, it was actually, when you think about the environment of ride sharing and what's happened and the amount of disruption in that industry, you would have expected over the last 3 to 4 years where it's really ramped up. A2B's actually posted a record revenue result in the last 12 months, and I think you know, one of the reasons for our interest in the stock is we think there's a big disconnect between what's actually going on fundamentally within the business or operationally within the business and the broader market's perception of how that business might be being disrupted.
And is there part of that because, you know, if you look at Uber the brand, if you're a consumer, it feels like a cool brand.
Yeah.
If you're taking a taxi, it feels like it's perhaps a bit dated, or it's a brand that's been disrupted. From a fund manager's perspective, or someone who's managing money professionally, you know, is there an element of career risk if they invest in a stock that's already being disrupted by this new age, cooler brand in Uber, compared to if they invest in a business which everyone else is comfortable investing in?
I couldn't agree more. I think that's absolutely right, that there's a bit of ego risk, I think, with an investment in A2B, in that fund managers, you know, our view is there'll be a lot of fund managers that just will not look at a company because it's boring, it's old school, it's traditional. You know, you could argue that it's being disrupted. And then on the other side, you've got Uber, which is growing quickly, you know, 20% year-on-year revenue growth, and you know, is ubiquitous. It's it's everywhere, and so we think that's absolutely an element of why there's this valuation differential in the market. So a big part of Uber's success and the reason why their costs are ballooning out, or their losses are ballooning out, is because they are spending so much money on advertising and promotion. And it's quite subtle, you would argue, like they're not, but Uber is, despite there's all the significant cost of running a global network, the significant regulatory costs, but a significant part of their cost base is that advertising and promotion spend, which is enormous, and incentives back to drivers.
Well, that's the other thing. They're happy to subsidise, driving costs to keep fares cheap. Do you factor in that those subsidies are going to have to end at some stage, given they're losing such vast sums of money?
Yeah, well, we don't factor that in as part of our model, but we would expect that at some point investors will get tired of funding Uber's operating losses. Now, whether or not that's 12 months, 24 months, 60 months down the track, we're not sure, but we think the company will need to display the prospects of profitability in the near term. Now, whenever that is, I'm not sure. The other thing that we've noticed in the industry, though, is the cost differential between using a ride-sharing app like Uber and a taxi have really compressed. So, when Uber came to the market here in Australia, it was significantly cheaper for someone to jump in an Uber and go from here down to the Docklands. The cost differential between a taxi and an Uber it's much closer now, in our view. And so, with good technology and a tighter cost differential, we think that the chances of or the significance of large market share losses are somewhat stemmed.
And it's about 7.5 times free cash flow it's trading for. What do you think would be a fair price for a business like this?
Yeah, so what surprises us when we look at the results, so that was, in our view, that was a very strong result from a business that has been under pressure historically. We thought that was a very strong result, and interestingly, the market sold the stock off. Now, we can't understand why that is. Maybe there was some commentary around outlook that would have helped. pacify some investors or part of the market. But we think the stock's worth more than $2 a share.
Yeah.
It's trading at a little under $1.50 a share. The market cap's around 170 million. We think that $2 a share is obtainable. We can see some catalysts on the horizon that might cause the stock to re-rate back to that level. But you're right, it's trading on modest multiples of free cash flow, single-digit PE multiples. We think that the company can easily afford to pay us a fully franked dividend yield north of 6%, and in that environment, that's especially when we compare that to the industrials market in Australia, which is trading on in our view astronomical multiples. This stock looks extraordinarily cheap.
And what are some of those catalysts you could see that could cause the stock to re-rate in the near term?
Yeah, now clearly something happening with Uber or Didi or Ola would be a very significant catalyst, but again, it's probably out of our short-term and medium-term thinking. The next result in February we think will be key. I think there's some people still scratching their head as how was A2B able to deliver such a strong result given the environment, and we think ultimately we think that stock prices will match fundamentals. At the moment we think there's a disconnect. Another strong result we think will help drive that. You mentioned acquisitions. We think that's a key part of it as well. If they're able to acquire, to build that network through acquisition, but even organically, we think the market will like that.
Do you think the ACCC might say you're allowed to acquire businesses in New South Wales, or do you think that's likely to be upheld, that they're not going to be able to go there?
I think that's probably going to be upheld.
Because of the pricing power to the taxi drivers or to the consumer?
I think that the ACCC, they don't like to see dominant market positions across the board in any industries, and
they obviously don't lump this as a ride-sharing business, and they separate taxis and ride-sharing companies.
They do.
Do you reckon that's right?
We can see both sides of the argument.
You're not like bagging the ACCC on camera.
We've actually had some favourable rulings from the ACCCs in other businesses, so the last thing I want to do is create any enemies.
Fair enough. Sorry, so we were talking about potential for re-rating?
Yeah, so that's, ultimately we think that fundamentals will drive the share price. I mentioned ComfortDelGro. We think they're in an interesting position with their shareholding in A2B. It might make sense for them to acquire A2B at the right time.
What size company are they?
Oh, they're enormous. So off the top, if they were to acquire A2B, and we've run the model, it would be a couple of % earnings accretive for them. But it's, for them, this is a good business here in Australia in our view, and it would be accretive. And this challenge they have with what's going on with Western Australia and them being a shareholder, they could arrest that pretty quickly by bringing those two businesses together. Again, we're not relying on that as part of our investment case. Ultimately, we think that earnings will drive the valuation. We actually think earnings will grow next year, which is probably there is a part of the market that believes that, but probably consensus is that earnings will continue to fall. But we think they've stabilised. What Uber and Ola and Didi have been able to do is actually grow the category. So when we look at personal transport, we actually think there's some very strong tailwinds. You've got an ageing demographic, but the cost of air travel in Australia has fallen, so there's been a significant swathe of the population that's been mobilised. Jetstar and Virgin have, a lot of people fly now. When you fly, you take taxis. We look at inbound tourism, that's grown at about 4% compound for 10 years. The Chinese and Indians, there's a lot of inbound tourism from that sector. The other thing that's happening that we've noticed is, there's this real shift in attitude towards asset ownership with the younger generation, so they're less interested in owning cars and arguably less interested in owning houses as well. And so,
do you think that's the thing, they'll get their status from holidays or things they can put up on social media as opposed to assets, particularly ones that are sitting dormant for the vast majority of the time?
Yeah, absolutely. I think that's the case, and I think we're only at the early stage of that as well. I think this has got a long way to play out. So when we look at that, it's another strong, potentially, multi-period tailwind. There's other factors at play here as well that we think can underpin growth. People are living in smaller houses. Like Australia's has been for a long time, but it's becoming increasingly urbanised, and people live in smaller houses, so they get out more. And when you get out more, you tend to get a taxi. Thankfully in society there is an increasing awareness of drink driving, and so people, society is moving away from drink driving. Again, that's supportive of taking a taxi to places. So and there's an ageing demographic, and elderly people tend to take taxis as well. So when we look at all that, we think this category can grow, and what Uber has done very successfully is they have driven the growth in the category. So they have taken some share from taxis undoubtedly, but they've also grown the category. So when we look at, Manhattan's a bad example, but when we look at, because it's not representative of most cities in the world, but there's very good data on the New York taxis. Over the last 5 years, the number of monthly taxi trips taken has gone from 15 million to up over 20 million trips per month. And so a big part of that has just been the accessibility of ride sharing. And so we think that's at play here in Australia as well.
And do autonomous vehicles come into your forecast at all, or by the time they're here you'll have sold on and moved on to the next adventure?
I've probably sold on and moved on, but who knows? It's still many years away. We've thought about it. What we do think is that a taxi network like A2B is better placed to have an autonomous driving fleet than someone like Uber, because if you think about who's subsidising Uber, it's, as I said, it's the drivers. Many of the drivers aren't, they're supplying their own vehicle, and they are almost uneconomic. They're having to work long hours for minimum wage. We think for them to pivot their business model towards autonomous drivers is very, very difficult. It would come with very significant capital cost, and to autonomous vehicles, I mean, that would come with very significant capital cost, and we're not sure that Uber's got the balance sheet to be able to do that. So that's still many years away, but it's, we've thought about it. We actually think that A2B is probably a better place than the majors in that environment.
And what would cause you to change your mind?
Well, there's lots of things that could happen here. We could see we could be wrong with our view that market share should remain fairly static from here. There could be a quantum shift in share from taxis to the new players, and so that would cause us to query our thesis. There's every chance that we'll see a cyclical decline. The Australian economy, we would argue, is not incredibly buoyant, and so there's potentially some cyclical factors that may impact.
Is it a discretionary spend?
There's a little bit of that, absolutely. So I think if you've only got $50 left in the wallet to get you through the week, you're probably not going to get a taxi out to down to the pub or out to a restaurant. So there's absolutely an element of that. Execution. If there was, if the company pivoted into a direction that we thought wasn't sensible, then we would probably query it. But it's early days for our investment. We've been buying stock very, very recently, but there's nothing on the horizon that we can see that's imminent that is going to cause us to change our view.
Beauty. Is there anything I've missed?
We've covered a lot. I don't think so. No, I think I think that's the thesis in our thesis, and we can see some short-term upside in the share price.
Awesome. Thanks very much for coming along. Hope you make plenty out of it.
Thanks for having me,
Thanks,
Chris.
mate.
Good on you. Cheers.
If you're interested in building your own investment process, make sure you check out Stock Doctor, the proud partner of Talk Your Book.